Get ready for a deep dive that will fundamentally shift how you think about high-yield investing. Seriously. We're about to unpack two ETFs promising insane annual returns, like over 120%. But there's a massive catch. You won't believe what happens to your money. Stick around, because the truth, it will S-U-Chi you. Today, we're unraveling the epic showdown between MSTY and ULTY, the $8 billion ETF battle. Which one will truly make you rich, and which one, well, could make you lose everything? You're with ChannelVest. This is your analysis.
Okay, but hang on. Before we dive in, it's really vital, absolutely crucial to understand this deep dive. It's for educational purposes only. This is not financial advice. Always consult a registered financial advisor before making any investment decisions.
Okay.
And remember, past performance does not guarantee future results. And these kinds of ETFs, they might not be suitable for everyone. Not at all. Our research, conducted by ChannelVest using AI tools, it's based on publicly available data through August 2025, just so you know.
Right. Absolutely critical disclaimer there. So here's what we're covering today, our roadmap. First, the high-yield battle. MSTY versus ULTY. Those headline numbers, then bam, the shocking performance breakdown revealing what's really happening underneath. After that, we tackle the intense risk analysis. I mean, could you lose everything? It's a real question. And finally, our surprising verdict on which fund, if any, truly deserves your investment dollars. Okay, let's unpack this. You won't believe these numbers. MSTY. It boasts an annual yield of 152.91%, paying out an average, get this, $2.20 per share monthly. And ULTY, not far behind, 126.21% annually, distributing about $60 per share weekly. This is insane. I mean, to put that in perspective, these yields are 10 to 25 times higher than traditional covered call ETFs. Think QYLD, maybe 13.21%, JEPI around 9.38%. It's just a different universe. But wait. Like I said, there's a massive catch coming.
And what's fascinating here, is how these extraordinary figures immediately grab attention. They just pull people in. They promise returns that, let's be honest, seem almost too good to be true for many investors. It's a powerful lure.
Exactly. And here's where it gets really interesting, and you won't believe it. While these ETFs promise these massive distributions, your principal, your initial investment, it's disappearing. Since inception, MSTY has declined by menacing 17.18%. Okay, bad, but listen to this. ULTY has plummeted an astonishing menacing 70.34%. 70%. This means a significant chunk of what you receive as income is actually just your own initial investment being handed back to you. It's not profit.
And this raises, I think, a really important question. If your principal is eroding at such a rate, how sustainable is that income? Really? It highlights the critical difference between yield, which is just the cash payout, and true total return, which includes how your capital's value changes.
Yeah.
Big difference.
You're with ChannelVest. This is your analysis. And next, we break down the underlying strategies of these two giants. What are they actually doing? So what are these funds actually investing in? Let's start with MSTY. We call this one the Bitcoin proxy. It offers 100% synthetic exposure to MicroStrategy, or MSTR. The company that famously holds a staggering, 279,420 Bitcoin worth billions.
Right. Billions tied to crypto.
Yeah, so MSTY's fate is really linked to MSTR's and the collateral for MSTY. Mostly U.S. Treasury securities, around 75% of its portfolio. Pretty safe stuff there. Its option strategy involves synthetic covered calls on MSTR.
Okay, let's pause on synthetic for a sec. That means they're not, directly owning MicroStrategy stock. They use derivatives, options mainly, to replicate its performance. Then they sell calls against that replicated or synthetic position.
Right. It's a way to get exposure without buying the shares directly.
Exactly. It adds complexity, maybe some counterparty risk, but it's capital efficient.
Got it. Now, ULTY takes a very different path. It's the diversified approach. It holds 120 individual stock positions, its top holdings. Things like AST Space Mobile, Rigetti Computing, IonQ, each around 4.6, 4.9%. Smaller, maybe more speculative names.
Definitely looks like a growth-oriented, potentially higher volatility basket.
Yeah, and the sector mix reflects that. Heavily weighted towards tech, 35.20%, financials, 21.45%, and communication, 18.32%. And ULTY uses a multi-stock covered call strategy across all these names.
So if we connect this to the bigger picture, you get two very different bets here. MSTY is super concentrated. It's basically a leverage play on Bitcoin via MSTR. ULTY spreads the risk across many stocks, but they still seem to be, pretty volatile companies themselves. So diversification, yes, but into what?
Good point. So what does this mean for performance? The numbers don't lie, folks, and they're coming up next. This is going to be eye-opening.
Okay, let's unpack this. The raw performance data for these funds, honestly, absolutely shocking. For MSTY, okay, current price, $17.55. Since inception, down negative 17.18%. Year-to-date in 2025 alone, it's lost negative 35.3%, and its one-year return, a painful negative 26.81%. Its volatility is extremely high, 81.94%, and the maximum drawdown, peak-to-trough loss, of negative 62.98%. Ouch. But despite all this, it has a positive Sharpe ratio of 0.204. Remember that number?
Okay, positive, but barely. Still, positive is better than negative.
Right. Now for YieldTY. Current price just $5.74. Since inception, it has plummeted, and I mean plummeted, an astonishing negative 70.34%. Year-to-date 2025, down negative 36.50%, similar to MSTY's YTD loss. But its one-year return is way worse at a negative 49.07%. Its volatility is high, though lower than MSTY's at 37.91%. But the maximum drawdown is even worse, a negative 72.99%. And get this, its Sharpe ratio is a negative 2.099, deeply negative.
Wow. And what's so fascinating here, well, maybe fascinating isn't the right word, telling perhaps, is how that Sharpe ratio clearly differentiates the risk-adjusted returns. Even though both show huge principal erosion, MSTY's slightly positive Sharpe means you got some compensation for the risk, above a risk-free rate. Barely, but some. YieldTY's negative Sharpe. That indicates it generated worse returns than just holding, say, Treasury bills after accounting for its own significant volatility. Essentially, you took on a ton of risk for less than zero reward compared to something safe. That's a really bad sign.
Less than zero reward for all that risk? Oof. You're with ChannelVest. This is your analysis. And trust me, the shocking risk levels we're about to discuss will make you think twice. Seriously, this is insane. How much could you really lose? Like, in a single bad day. Let's top value at risk there at a 95% confidence level, so 1 in 20 chance it's worse. On a $100,000 investment, MSTY could see a one-day loss of $8,491, almost $9,000 gone in a day.
That's significant daily volatility.
You bet. And ULTY, while lower volatility overall, still faces a $3,928 one-day loss, nearly $4,000. Still a huge hit for one day, but that's not all. Let's imagine some crisis scenarios. Again, $100,000 investment. In a 2008-style financial crisis, MSTY could lose $68,500, ULTY $52,800. More than half your money gone.
Okay, those are model scenarios, but they reflect the inherent leverage and volatility.
Right. A COVID-19 type crash. MSTY could lose $51,200, ULTY $42,400. Still brutal. And here's one specific to MSTY, a crypto winter. Bitcoin drops 80%. MSTY could lose $72,400, while ULTY, less tied to crypto, would still be down $31,600 in that scenario.
And this really forces the question, doesn't it? Are the potential rewards, even those massive yields we talked about, truly worth exposing yourself to such devastating drawdowns? It forces us, and you listening, to consider the worst-case scenarios, not just the best-case high-yield dream. What's your actual tolerance for seeing your capital cut in half, or worse?
Exactly. So what does this all mean for the smart money? You know, the pros. Are they touching these things? You won't believe it, but their actions might surprise you. You won't believe it. When it comes to institutional confidence, there's a clear winner here, MSTY. It has 890% more first-time institutional investments than ULTY.
890%. That's a massive difference in adoption by bigger players.
Huge. And we're talking serious names. Legendary Quant Fund, Renaissance Technologies. They hold a $4 million position in MSTY, Rentech.
Wow. Okay, that's notable.
And Private Advisor Group opened a whopping $7.5 million position in MSTY just in Q2 2025. If you look at the Q2 2025 data, the institutional buying versus selling heavily favors MSTY over YieldLT.
Right. Now, what's fascinating, or maybe revealing here, is that despite MSTY's extreme volatility, despite the principal erosion we've hammered home, significant institutional players are still allocating capital. Now, this doesn't mean they think it's safe. It likely suggests these funds play a very specific, maybe tactical role within highly sophisticated, diversified portfolios. Probably has a small, high-risk, maybe uncorrelated allocation. They understand the mechanics and the risks probably better than most retail investors. It's not a core holding for them. You can bet on that.
That's a really important distinction. It's a tool for them, not necessarily a foundation. Okay, before we reveal how these complex ETFs actually work, how they generate those yields, a quick word for you. Don't miss our next financial analysis. If you're getting value here, hit subscribe. Seriously, click it now and turn on notifications to get our next deep dive on high-yield investment strategies. And here's a bonus for you. We're giving away a free investment guide. First 1,000 subscribers who comment Yield Hunter below get it. Go comment. Okay, let's unpack this. How do these funds generate those insane yields even as your principal disappears? It's a complex 4-step strategy. It's kind of clever, but also risky. First, they buy treasury collateral, like we said, holding cash like treasuries. That's the safe base. Second, they create synthetic equity, using options, futures maybe, to replicate the stock exposure, MSTR for MSTY, that basket of 120 stocks for ULTY.
And again, that synthetic part is key. Capital efficient, yes. But it means they're not actually owners in the traditional sense. They're using derivatives to mimic ownership. Layers of complexity.
Exactly. Third, and this is the big one for yield, they sell covered calls against these synthetic positions. Way out of the money calls, likely, to maximize premiums.
Or maybe at the money, depending on the strategy. But selling calls generates income upfront, the premium.
Right, that's the cash inflow. And finally, step 4, they distribute income from the premiums received. But crucially, this is where the NAV erosion comes in. The premiums they collect, plus maybe some small dividends or interest, often aren't enough to cover the distribution and maintain the value if the underlying synthetic position doesn't appreciate enough or depreciates. So they pay out your own capital back to you.
Precisely. It highlights that the income isn't primarily generated from, say, the underlying company's earnings growth or sustainable dividends. It's from an option strategy. That strategy inherently trades potential upside because the calls cap gains for immediate cash flow. Often, as the numbers show, at the direct expense of capital appreciation, or worse, leading to capital depreciation.
That trade-off is everything. Upside capped, income now, principal potentially eroding. Okay, so let's put this into perspective. How do these YieldMax style funds compare to the covered call ETFs maybe more people are familiar with? You know, like QYLD or JEPI, traditional covered call ETFs, your QYLDs, your JTIs. They offer much lower yields, right? Typically 7% to 13%. Noticeably lower.
Much lower, yeah.
They also generally have much lower volatility. They aim for smoother rides. They provide better principal preservation. That's a key goal for them, usually. And they come with lower expenses, maybe 80.35% to 0.60%.
So a more conservative approach overall, focused on income, but with an eye on keeping the principal relatively stable.
Exactly. Now, YieldMax ETFs, like MSTY and ULTY, they deliver those massive yields we talked about, 126% to 153%. Huge difference. But EST, they come with extreme volatility. We saw the numbers. They lead to severe principal erosion. Again, look at ULTY's 70% drop. And they have higher expenses, 0.99% to 1.30%.
Yeah.
Almost double, sometimes triple the cost.
So this stark contrast, it really forces a critical question for you, the listener. Are you chasing yield at any cost? Or are you prioritizing capital preservation and looking for long-term total return? The trade-offs are incredibly clear. You get massive yield, but you risk massive drawdowns and principal loss and pay more for the privilege. It's a very specific choice.
Couldn't have said it better. The moment of truth is here. Our final verdict is coming. And it has some surprising conclusions for you, maybe not what you expect. So what does this all mean? After crunching the numbers, analyzing the risk, looking at the pros, the final verdict is in. And our analysis points to MSTY as the winner. But hold on, let me explain. Winner in this specific high-risk comparison.
Yeah, winner needs a big asterisk here.
Absolutely. Here's why we lean towards MSTY over ULTY. First, superior risk-adjusted returns. That positive Sharpe ratio, 0.204, compared to ULTY's terrible, Magnus 2.099. It matters. Second, much better principal preservation, relatively speaking. Declining now at 17% is bad, but it's way better than ULTY's catastrophic negative 70%. Third, it offers a higher yield, 152.91% as HV at 26.21%. And fourth, as we saw, significantly stronger institutional confidence. The smart money seems to prefer it for whatever specific reasons they have.
Okay, based purely on the data compared to the two, that logic follows. MSTY looks like the less problematic of two very problematic options if you're forced to choose.
Exactly, but beware. And this is huge. You won't believe the caveats here, because they apply to both. Both funds suffer from that structural principal erosion. Your capital is designed to shrink over time if the underlying doesn't massively outperform. They both come with extreme volatility. MSTY at 82%, ULTY at 38%. Huge swings are normal. There's potential for massive drawdowns and market crashes. Remember those 50%, 60%, 70% plus loss scenarios? They're real possibilities, and they have complex tax implications with their return of capital distributions. It's not simple dividend income.
That return of capital aspect means you're lowering your cost basis, potentially leading to larger capital gains taxes when you eventually sell, assuming there's anything left to sell at a gain.
Right. So our recommendation for you, if you're even thinking about these, limit them to a tiny speculative slice of your portfolio. We're talking 5–8% of your total portfolio. Maximum.
Seriously, treat it like venture capital. Money you can afford to lose.
Totally. Consider dollar cost averaging in over 3–6 months maybe to smooth out the crazy volatility a bit. Don't just jump in all at once. And crucially, Crucially, these are only suitable for investors comfortable with 70% plus drawdowns. If seeing your investment drop that much make you panic sell, stay away. Far away. For safer income, seriously, just consider traditional covered call ETFs like QYLD or JPI or other income strategies. These are not for the faint of heart.
And if we connect this to the bigger picture, it's about understanding that winning, in this context, MSTY over ULTY, doesn't mean it's a guaranteed path to riches. Far from it. It just means it performed less poorly on a risk-adjusted basis than its direct competitor within this very, very high-risk category. Critical thinking about your own risk tolerance, your actual financial goals, that's paramount. Don't just chase the yield number.
So well put. You're with ChannelVest. This is your analysis. Don't go anywhere because we've got more for you. We want to help you navigate all this. Get more financial content that actually help ES. Follow us. We drop daily tips, market updates, and those quick 60-second strategies. Okay, now, for the big question for you, our amazing listener. After hearing all this, the insane yields, the shocking drawdowns, the eroding principal, would you risk 70% of your principal for 150% annual yield? Let us know in the comments below. What percentage of your portfolio, if any, would you actually allocate to high-risk, high-yield ETFs like these? Be honest.
Yeah, and this question, it really prompts some important self-reflection, doesn't it? Truly knowing your own financial psychology, understanding your genuine comfort level with volatility, and grasping the real costs, the potential downside of chasing that headline yield. That's perhaps the most valuable takeaway from this entire deep dive. Your answer says a lot about you as an investor.
Absolutely. The most interesting comment gets pinned and featured in our next deep dive. We can't wait to read what you think. Until next time, stay curious and keep learning.